Hello and welcome to Chapter 11. So we are talking about reporting and analyzing shareholder equity in Chapter 11. So our learning objectives here is to identify and discuss major characteristics of a corporation. We will be looking at recording share transactions. We will prepare the entries for cash dividends and look at the equity representation in the financial statements. So your corporation form of business. Now, we had talked about our corporations in the earlier chapters. So corporations do have a separate legal entity, which is distinct from its owner. So owner and corporation are seen as two different legal entities. And the right and privileges of the corporations are quite similar to that of a person. Now, when the corporation is set up, the corporations can be set up as a public corporations or private corporations. So if the company decides to list the shares on any stock exchange, then it becomes a publicly traded company, which is a public corp. On the other end, if the shareholders do not list on any stock exchange and the shares are closely held, then it is classified as a private corporations. Now, depending on the type of corporations, there are different accounting guidelines that we had discussed in past. Publicly traded companies have to go with international financial reporting standards. There is no choice. But when it comes to private corporations, they have to apply accounting standards for private enterprises, ASPE at the least. If they do choose to go with IFRS, then they do have that choice. Now, these are the characteristics of the corporations. They do have a separate legal existence from their owner. The biggest advantage of the corporation is the limited liability to the shareholders. So the shareholders' risk is limited to what they have invested in the business. Anything that the shareholders own outside of that is protected. So should something happen to the corporation, all they would lose is the investment in the corporation, but any other assets and items that they have outside of the corporation that they're invested in would be safe and secure. So that is very limited liability for the shareholders. The ownership rights can be transferred fairly easily because the shares can be transferred from one person to the other relatively easily. So the corporations do have the ability to acquire capital either by issuance of shares, or they can approach the bank if they want to go with debt financing. So the institutions are more willing to lend money to corporations. The corporations also have continuous life. So if you remember from our earlier discussions about the partnerships and proprietorships, those forms of businesses are limited to the life of their owner. But with the corporations, here the life is not tied to the shareholders, so the business has continuous life. The corporation's management is done by the managers. The corporation does have to go through the government regulations of making sure that the payroll taxes are remitted, the income taxes are filed on time. The corporation has to file for income tax return at the end of the year, and that's your income tax that the business has to pay. Now, when we look at the good and the bad side of the corporations, really all of that is practically an advantage. On the flip side, the only thing that doesn't quite work well is the complexity. So depending on the corporation and the amount of work and the complexity of their operations, it is quite complex. It can get quite complex with the regulatory requirement. So there is heightened reporting and disclosure requirements as well when it comes to corporation. So more complex their operating structure, more requirement there would be for from the government bodies, from the Securities Exchange Commission, if the corporation is publicly listed. Everything else is then advantage. It has a separate legal entity. The best part is limited liability. The ownership transfers can the right or the ownership rights can be transferred, which is shares transferred from one person to the other. The ease of raising capital either through debt financing or equity financing, continuous life, separation of management and ownership, and reduced income tax. So the income tax paid by the corporation generally tends to be in the lower bracket. Now, when the shares are issued, so in order to raise the capital, the corporation can sell their own shares. Okay, so they're selling their rights in forms of shares. So when the shares are sold, the corporation gets the money. Usually, the common type of share that is referred to is the common share. So when they say shares, they are technically referring to common shares. The other type of shares that can be issued are your preferred shares. Both common and preferred shares are your share capital. The ownership rights are specified in the article of incorporation or in the bylaws. That is the rights in voting, dividend, and liquidation. So who has what rights? That information is stated in your article of incorporation or in the corporation's bylaws. The companies can issue the shares, but in order to issue the shares, they need to have authorized shares. So the companies do have to go through the Securities Exchange Commissions. We're talking about publicly trading companies here to establish what is the maximum number of shares that they are allowed to sell in the market. The companies cannot decide to sell whatever number of shares that they wish. Okay, so they have to go through the Securities Exchange Commission to determine that. So once the company knows the maximum amount of shares that they are allowed to sell, that is called as their authorized capital. Sometimes it could be limited, other times it could be unlimited, but they still have to go through the process. Now, the authorized capital, that information is shown on your statement of changes in equity or your retained earnings, but there is no recording that's needed for that. All right. So if the company hasn't issued out any shares, then you don't need to record anything. You just need to disclose the number of authorized shares. If that is unlimited, then we say it's unlimited. Now, out of those authorized shares, the number of shares that the company has actually issued is your issued shares. The legal capital is the share capital that cannot be distributed to the shareholders, unlike retained earnings, which can be distributed as dividend. Now, if you think of your dividend reduces your retained earnings, okay? So the companies can practically to pay out everything that's in the retained earnings in form of the dividend. But that same idea does not apply to legal capital. The legal capital has to be maintained and it cannot be distributed to the shareholders the same way retained earnings can be. When these shares are first issued by any corporation, they are issued through initial public offering. We call it as IPO. At that point in time, when the IPO is issued, at that time, the companies set the share prices. But once that issuance is completed and the shares are listed on the stock exchange, after that, the share prices are determined by the buyers and seller. It has no direct impact on the company. The fair value of your shares is determined by the market forces. If there is more demand for the shares, the share prices will go up. If the demand is lower, the share prices will come down. So company cannot control the share prices once the IPO is done and the shares are listed on the stock exchange. Now, in terms of issuing the common shares can be issued in various instances. The most common way to issue your common share is against the cash account. So we debit cash account, credit common shares. The normal balance for common shares account, this is a share capital, is credit. So share capital basically is the total amount that is paid by the shareholders to the corporations for the shares they hold. So the total amount paid by the shareholders to the corporation for the shares they hold. Now, there can also be some barter or non-cash transactions when the shares are exchanged. In that case, depending on whether the company is following IFRS or ASPE, we will determine the amount of that transaction. Under IFRS, we will record at cash equivalent price, which is ideally the fair value of consideration that you are receiving, not the shares that you're giving up, because those prices are quite liquid. Right? So if you received an asset worth $10,000, that was the cash equivalent value, but the shares given up were for $11,000, then your transaction is only worth $10,000 under IFRS. Under ASPE, the fair value of the shares given up or the fair value of the consideration that we have received, whichever you are able to measure more reliably is what we will go with in ASPE world. Now keep in mind, in ASPE world, it's rather hard to find the fair value of the shares as well. Share value comes from market. In IFRS or publicly traded companies, the shares are trading and we can relatively easily get the fair value. But in the ASPE world or the private corporations, their shares are not trading on any stock exchange. So it's rather hard to get the fair value of those shares. So either the fair value of the shares that we are giving up or the fair value of consideration we have received, whichever you can measure more reliably is what your transaction will be accounted at. Now, talking about your preferred shares have the contractual provision, and these guys would always have priority over common shareholders. Preferred shareholders will never get a voting right. So the distinction between common shares and preferred shares is common share is a plain old vanilla common share. Okay, it's like vanilla ice cream. It tasted the same 10 years ago, it tastes the same today. Okay, so that is what common share is. Nothing changes whether you got the share today or you got the share 10 years ago. It is going to be treated the same. Okay, nothing more, nothing less. Every common share comes with a voting right, and that's it. On the other side, though, your preferred shares do not have voting right. These guys will never have the voting rights, although they are shareholders, but they will not have the voting rights. But they do have preference over the common shareholders when it comes to dividend and liquidation. So when the company is issuing preferred shares in exchange for cash, we are debiting the cash account and crediting preferred share account. The preferred share account is the share capital. Normal balance is credit for these guys as well. So the impact of this transaction on your accounting equation, your asset is going up, which is your cash, by $50,000, and your preferred shares is your share capital, so your shareholder equity is also going up by the same amount. Okay, when it comes to the dividend, your preferred shareholders are always paid the first. Now, what is dividend? Dividend is the money that is paid by the company to their shareholders. So when the companies declare dividends, it will first be paid to the preferred shareholders, and then it will be paid to the common shareholders. Even amongst preferred shareholders, there are certain preferred shares which were, if they have a feature called as cumulative attached to that, then cumulative means that you will have to pay the dividend in arrears on those shares before anyone else gets paid. So at the time the company is issuing the preferred shares, if the shares were sold with the cumulative feature, then these guys will get their dividend first for the prior years. So generally speaking, the way that dividend works is dividend is only paid if it was declared by the business. If the dividend is not declared, then nobody gets paid. Doesn't matter whether it's a common shareholder or it's a preferred shareholder. If the dividend is not declared, nobody gets paid. But if the dividend is not declared, then the cumulative preference share dividend is not lost. It will just get carried over up until it is declared and paid. But for all the other types of preferred and common shares, the dividend is lost if it's not declared. There is no carryover rule for them. But these guys do have it. So it's a very special feature. So at the time the company has issued the preference share, if they did issue with the cumulative feature, then as soon as dividend is declared, if there is any dividend that is unpaid or in arrears for these cumulative preference share guys, then it will be cleared first for the prior years. Then these guys will be paid their dividend for the current year, and finally it will go to the common shareholders. Preferred shareholders also have liquidation preference. What that means is, in an event where the company is liquidated, these guys will have first claim to their assets before the common shareholders. The other features that can be attached to preference shares is convertible. The preference, if the convertible feature was sold, um, then the preferred shares can be converted to common shares. The preferred shares are traded less commonly compared to your common shareholders. The pricing is also different. So if the shares were sold with the convertible feature, then the shareholder does have the option of converting them from preferred share to common share should they choose to do that. The other sweetener or option that can be added to the preferred shares is redeemable or callable. This is purely at the company's discretion. So if the company thinks that this comes from the future planning. So when the company was issuing these shares at that point in time, if they said, looks like we are going to do great in the next 10 years, and we want to sell these shares with the redeemable or callable feature, that means the company will have the ability to call back these shares anytime. And the shareholders have to give them up. It's not a choice at the time. Okay, so it's a great option for the company, and that's the only way the company can actually force these shareholders to give up their shares. Otherwise, once the shares are issued out, they are out in the market. The last option that can be added to your preference shares is retractable, which is the exact opposite of redeemable or callable, but that is at the shareholder's discretion. So if the shares were retractable, then the shareholder can sell their share directly to the company if they choose to do that. So we will be discussing more about these feature and dividend payments here in E11-2. So dividend, as we said, is the distribution of your retained earnings to the shareholders. The dividend has to be declared before it can be paid. Once the board of directors declares the dividend, they will vote and decide whether the dividend should be paid. Once they do decide that yes, the dividend will be paid, then the allocation of the dividend is prorated. What that means is each common shareholder will get the same amount of dividend per share. So the most common type of dividend that is distributed is cash dividend. The other alternative to pay out dividend is stock dividend. So we expect you to know about the stock dividend, where the company can issue out additional shares to the shareholders, but we are not testing or elaborating on the stock dividend here. We are focusing on cash dividend. So cash dividend is where cash is paid by the company to those shareholders. So when the board of directors do declare the dividend, for the dividend to occur, the corporation first of all has to meet a two-part solvency test that is set up by CBCA, and the effect of the formal declaration of dividend by the board of directors has to be accounted for. So when it comes to the cash dividend, there are three primary dates that we have to go with: the date of declaration, date of record, and finally the date of payment. So on the date that the board of directors formally authorized the cash dividend, it becomes a legally abiding obligation. Then there is no going back for the corporation. They have to find ways to pay that cash dividend once it's committed. Okay, so in this case, declaration on December the 1st of 50 cents per share cash dividend on 100,000 common shares. As soon as the board of directors declare the cash dividend, it becomes a legal liability and it has to be paid. So on December 1st, on the date of declaration, we will set up our liability by crediting dividend payable for $50,000, which is 100,000 shares times 50 cents. And we are debiting our dividend declared account, which has a normal balance of debit. On the date of record. Date of record is an internal process where the company has a cutoff date and they look at all the shareholders that own the shares of the company as of that day, and they start preparing the checks to go out in the mail. So record date is purely an internal process from the company's perspective, so we don't need to make any journal entry. Once those payments do go out, that is your date of payment. So once those checks go out, the company has satisfied their liability. So on the date of payment, which in this case happens to be January the 20th, we are debiting our dividends payable liability and crediting our cash account. So the effect on our accounting equation is cash going down is reducing your asset by $50,000. And the dividend payable is a liability that is reducing by $50,000 since we are debiting that. In this case, the cash flow impact would also be $50,000 because your cash is going out. This is another example that we will look at in class. Stock split. Now, stock split is where the company will go ahead and issue out additional shares. So the companies try to keep the trading prices or the share prices in an optimum window to attract most activity. So an indirect way to control that for the business is through a stock split. So stock split is like a stock dividend, but usually it is much larger in size. So company could say that old old one share is now 5 shares. Okay, so they will cancel out the old one share and replace it with 5 new shares. So the share prices will fall by 5 times, which is in line with the share split. But if you look at the total shareholder equity on the books of the corporation, there is no impact. There is no fresh cash coming in or leaving out. All that's happening is the number of shares outstanding will increase 5-folds in this case, and the market prices will drop by 5 times. Okay, there is no journal entry that is required for stock split, but we do have to indicate that information in the notes to our financial statement. So no journal entry, but notes disclosure with the details is required. When it comes to statement of changes in equity, which is prepared under IFRS, we will disclose the changes in the shareholders' equity for that period for all of these accounts, for share capital, contributed surplus, retained earnings, as well as accumulated other comprehensive income, also called as AOCI, which is required under IFRS. Under ASPE, though, we prepare our statement of retained earnings. So for the private enterprises, usually their share structure is not very complex. So we just show the amounts and the changes in the retained earnings during that period through the statement of retained earnings under ASPE. And that, my friends, is the comparison between IFRS and ASPE when it comes to non-cash considerations that we had talked about, the barter transaction and comprehensive income. The concept of comprehensive income does not exist under ASPE, so we don't worry about that. So this is all we have for this chapter. Thank you for listening in, and take care.